All right, we are going to get started. Hello, everybody. It is September the 2nd. Can you believe that? It's already the start of the school year. So I'm a day early because school starts tomorrow, but it's Monday. So I'm, of course, here on this. So thank you very much for tuning in. My name is Hung Lu, and I am with Cash Property Inc. And today on Money Matters, we are going to be talking about how to calculate um, ROI using OPM and private money. Okay, so it's going to have a bunch of moving parts on it. And then I got a really interesting question that came through. And so we will answer that as well afterwards. So now before you go and implement any of the stuff that I talk about, please go and check with somebody else. Okay, so let me see here. Yeah, absolutely. So the outcomes of these calls that I'm doing is really to put the knowledge out there. And after meeting, having the question that I'm going to be answering today, I realized, oh my God, I need to get more of this information out there. So thank you for tuning in. Okay, so let's see. So we are at the beginning of the month. So I'm just going to put a little plug in here. If you want to be invited to our monthly mastermind, which is coming up in the third Friday of every month, click on the QR code and let me know you want to come. And then you can get invited to this 2-hour mastermind where we talk about real estate. Okay, so let's go into the calculation sheet on how to calculate the ROI when you're using OPM and private money. Okay, so this is a bit of a challenging question to demonstrate out. So let me share the Excel sheet. So this is a spreadsheet that I've built out and I've been using for a while. It's pretty much like the single family sheet that I use. So let's go in here and I will walk you through it. Okay, and if you have any questions about this spreadsheet, please reach out to me and just let me know. Okay, or put them in the comment box. Okay, so this is one where I'm just looking at some cabins. So just, a business plus land. Now you can set this up any way you want. Okay, so the way I'm doing it is I'm just using 6 cabins here. And I'm using a 72% occupancy rate. Okay, so usually for cabins, like when you get into your like when you start doing your due diligence and learning about the different strategies, you'll understand what this occupancy rate is. So at this point, I'm just using a 72% occupancy rate. I've got my low, mid, and high cost per night. Okay, so these numbers are just, made up numbers, okay, just to share with you some ideas here. And then I've got a breakdown of all my expenses. Okay, there. So basically, I'm operating at around a 36 to 52% expense ratio. Okay, for a hotel, campground, stuff like that, this amount will range depending on your staff level, what sort of other expenses you have, and if you have food, like if there's a restaurant component or even a liquor component to it. Okay, so let's see here. So then I go into calculating the cash flow before debt servicing. And so this is an interesting calculation here because I am not including any mortgages, any private lending, any of that debt servicing to acquire to maintain this opportunity. So I have this number calculated first. Okay, and so the calculation for that is just the income minus the expenses. So all of the income minus all the expenses less debt servicing. Okay, so that number for this, in this example here, I'm making between 6,000 to 12,000. So there's a huge range there. And the reason for that is because of this low and high range on the fee that I would be charging per night on these cabins. Okay, so I've developed this spreadsheet so that I can do tents, rooms, camping, clamping, whatever you want to call it. Okay, and then it's got a different unit number with a different pricing. And I can actually set this up so I'm calculating by month, by week, and by night. So usually for like cabins or tents or RVs, it's by night. Okay, so here we're at debt service ratio. the cash flow before debt servicing is between the 6 to 12,000 a month. Okay, so that's actually a decent type of return here. Okay, but now what we're going to do is calculate, well, what's the actual ROI? Okay, so let's just say that the purchase price is just around 1.7 million. There's a land transfer tax here of 50,000. So depending on which province this in, this amount's going to change. Okay, so right now I've just got a placeholder in there for 50,000. I've put a 5% closing cost. Okay, so that's going to cover land transfer tax, potentially, being under that, any legals, any environmental reports, appraisals, anything like that that I need to pay extra for. So that's part of the 5%. Now I'm running an amortization of 20 years, okay, and an interest rate of 7%. So now if you're thinking, well, Huong, you can get an amortization for 25, for 30 years. Yes, that is true. But at this point, I'm just underwriting my deal, and I don't know if the institution is going to give me 25, 30 years. So my opportunity has to work sort of at the 20-year mark. If it doesn't work, well, then I can adjust it and make, change it accordingly. But it comes into part of the negotiations, right? So at this point here, with the monthly payment on the mortgage, I'd be looking at about just under $8,000. So this is just a formula in here, the PMT formula, PMT, okay, in Excel. Okay, so I just use that formula. That calculates my monthly mortgage payments, okay? If I wanted to calculate the principal pay down and the mortgage pay down, well, there's another formula for that. Okay, so in this case, because it's a business, I'm going to go with a 60% loan to value. Okay, and yes, there are institutions that will lend you up to 75%, but I want to see what this opportunity is going to look like sort of at the worst case scenario. Okay, so 60% loan to value, that means my down payment here is going to be around $679,000. So this is just calculated based on the purchase price. And so I'm not, at this point, I haven't negotiated for anything yet. I'm going to get a loan to value at 60. Okay, so that means the down payment that I need to put in is 679,000. Okay, so the closing cost is, let's see here. So what I'm doing is I'm saying, okay, well, what's the fee for the 5% plus the land transfer tax? So that's going to be my closing cost. So I'm going to need about 134,000 extra in cash, liquid cash available so that I can close. Okay, and then the initial setup would cover any renovations, any unforeseen expenses that I would need within, the 1 to 2 months of closing. The last thing you want to do is use up all of your liquid money or access to cash, and then you take over this opportunity, and then you don't have enough cash or credit card access or HELOC money to be able to cover some contractors coming in or some unknown expenses that wasn't captured in the appraisal or the inspections or anything. Okay, so I've got 200 there. You can adjust that to whatever number you want. So that means in total, I need just over $1 million to be able to execute on this. Okay, so that's just adding up the down payment, closing costs, and the initial setup. Okay, so that's just over 1 million. And so if I was to bring in money partners in here and each person was to say put in 100,000, each of those money partners would get about 7.89% if they were to only put in the 100,000. Okay, so this calculation is just based on the 100,000 divided by the total amount of cash that I need to execute on this opportunity times whatever the percentage of equity I'm going to be giving to my money partners. Okay, so I'm using 80% here. That's pretty high. Usually it's like a 50-50, 60-40, 30-70. I have 80 here because I was running some examples here and I wanted to see, okay, at what point does it become attractive to a money partner coming in. So at 80%, the return on investment to a money partner potentially is around 8.7%. So, if I'm putting my money into this opportunity, I wouldn't want to do this. It's only 8%. Okay, it's not. So, when I do these opportunities, I want it to be north of 10, north of 15, ideally 20+%. That's going to be going to everybody. Okay, so here, what I've done on this table here is I've just calculated saying, okay, if I'm going to bring in 4 money partners and each money partner is bringing in a certain amount, let's say 350, 600,000, 500,000, what is their percentage of partnership here? Okay, so here I'm raising so I'm raising the 1.7. Oh, so that's too much. I've already raised way too much here. In this case, I only need to raise 1.04. So I wouldn't go all the way up to 1.7. So then see here, so it's telling me that I've already raised way too much here. So what I'm going to do is actually go down and say, get rid of this money partner. So I don't need them. And I'm still way over here. Okay, so I'm actually going to get rid of this partner here. So this is, let's see, raised enough. Oh yeah, so I'm still over. So I'm over by 9% here because I only needed just over 1 million, but I've raised 1.1. So here, what's happening is, let's say here, so 750. Yeah. So let's just take that to 500,000. Okay. So what's happening here is that the returns are still about the same here. It's like 8.73%. So as an investor, I wouldn't come in on this deal because I can put my money into a GIC, let's say, and get 4 or 5%, right? And so why would I take that risk of potentially leaving my money in for a couple of years and not getting, losing some of my capital as well? So this 8% needs to be way higher for it to make sense, which is why I was playing around this 80%. So if I went down to a traditional 50%, okay, the investment here is still about the same. Okay, so let's see here. So they're putting in their money and the cash flow is based on that. So the mortgage pay down, I have it as a 3%. I'm just estimating what the mortgage pay down is going to be, just to give me a quick number to say, hey, is it worth pursuing to bring in money investors on this? The appreciation, I put it down 5%. It could easily be 0. It could easily be 8% as well. So I'm just putting a number in here to see what it would look like. So if this was an opportunity, let's say in Southern Ontario, or maybe in like the busy areas in BC, this appreciation could be a lot higher. Okay, so you want to take all of those factors into consideration here. Okay, so this is the one calculation here. So here, what I'm calculating is percentage of LP. So because I've gone over on the amount that I raise, the percentage on the LP is higher than what I have allocated, because there's only a 50% equity going to the money partners here. Okay, so they're going to make about 8%, which isn't great. So the other thing that I like to calculate while I'm doing businesses is looking at, okay, well, if I was to just bring in all of the cash, so rather than giving away equity to a potential money partner, is if I just get private money and access equity from my current portfolio, could I fund the deal on my own, and does it make sense to do that? So here I've got a private lender coming in at 15%. So I realize that's high, but part of doing this is saying, is there enough cash flow from the current business, from the current situation, to allow me to acquire the business without having to do some forced appreciation, having me to, increase the rates or anything like that? Does the current business justify buying it using private money? Okay, so I'm using 15% here. So that means that based on the down payment of this amount here, okay, I would be paying about 101,000, so $102,000 per year in just interest payments. Okay, so private lending, the way I'm running this is just with interest only payments. So that means it's 8,400, so 8,500 a month that I would have to pay in interest only payments to just cover the down payment portion. So that means I would actually be out of pocket $7,000 a month. So I would have to really look at this and be like, okay, well, maybe I can get the private lending down to 12%. Maybe the down payment could go up to a 70% loan to value. Okay, so if that's the case, then potentially my shortfall wouldn't be that, but like there would be less of a shortfall. So let's go here and let's change this to 70% loan to value. Okay, so as you can see now, my shortfall is 6,000 instead of the 7,000. Okay, so now we're going to go and adjust this private lending. Let's just say I can get it for 12%. Okay, well, now I'm down to $5,000. So let's just say now the closing cost 5. So if I can get this interest rate down to 6%, okay, and if I can increase, let's just say to 25 years, okay, so now my shortfall is 3,400. Okay, so now it's really just saying, okay, well, where do I need to be to make this opportunity work? Okay, so now this, let's just say I get this at 1.6 instead of 1.7. Okay, so now the monthly payments is this, and my shortfall now is just under $3,000 a month. Okay, so there's a lot of moving parts here, and maybe I can, maybe the rates that I'm using the mid-range here of 125. Well, maybe the actual that they're getting is maybe 130, 160. Right? So let's just say on the high end, so I'm going to change this to 125, and then I'm going to change this to 160 here. Okay, so just going up by $20 a night, I'm now at 224,000 for the year. Okay, so if I just go back a little bit, oh, actually, I don't need to go back because we had the 125 earlier. So it was at 197. So going up by 20 odd dollars, I've added in about $27,000 a year in profit. Okay, so what that does then to the numbers is the mortgage payments are still the same, but now my shortfall is only about $500 a month, which is decent. Okay. Now, the other thing that I run here is, okay, well, if I have to go and borrow private money to cover all the closing costs and the initial setup fee. So now I've got 800,000 that I need to have available in cash. So that means my interest payments, okay, is the 800,000 times the 12%. So my monthly interest only payments to this private lender, in this fund, this private lending is going to take place on another portfolio. It's not going to be on this property. So then I take that cash from them and I go and I put it onto this property. So it's like my own liquid cash. It's going to cost me about $8,000. Okay. So I'm now in the negative by 3,800. Okay, so this is one of the reasons why I always tell people, like, you do need to have some cash because you need to cover closing and you need to cover the initial setup. If this initial setup, let's just say it's 100,000 instead, right? Then that makes a huge difference here because now it's 2,800 for that monthly payment instead of 3,800, right? So that's a huge difference there. Okay, so let's go back here and see that. So that is how you calculate the ROI on using other people's money and how to calculate your ROI if you had to use private money, right? Because if you can make this project work by using private money on your other portfolio to bring that in and you don't need to have money partners, then it may make sense for you to buy this opportunity. Okay, I can't believe that was like 25 minutes of talking about just this one simple calculation. All right, so I realize that it's not super simple. Okay, because I look at Excel every day and do my calculations, you know, when you start looking at it this often, then it does make a lot more sense, and you start realizing where you're potentially missing some numbers here. Okay, so let me go into the question that I got that came in, and thank you for sending this question in. So this is around what to do with inheritance money. Okay. And, you know, if you are in the lucky position to get inheritance money, which is like a windfall, okay, I would be like, hands down, so super happy for you and just say congratulations. And I know what that's like because I was really lucky. My dad actually gave me my inheritance money while he was still alive. And so I was, able to take that and leverage that to buy my second property. And of course, that allowed me to, do more investments, right? So if you are able to get inheritance money, you're in a great spot there. So perfect for you. Okay. So what to do with inheritance money? So there's tons of stuff you could do with it, but here is what I would hands down suggest. Okay. First thing, is to take some of that inheritance money, okay, if not all of it, take some of that, look at the credit card balances you're carrying. If you're carrying any sort of credit cards, pay those off in full, okay? I had this crazy coaching call one time where somebody said, hey, Huong, I'm really good with money. I pay off my credit cards, like I pay the minimum balance every single month. And I'm like, what? That is not the same thing as paying off the balance. If you're paying the minimum balance every single month, you are putting yourself into a deeper hole. Okay. And so after having that conversation, I realized, and they realized that they had a total misunderstanding of what paying the full balance of a credit card balance meant compared to just paying the minimum balance. Okay. So if you are carrying a balance on your credit card, pay it off. If you're carrying a balance on your line of credit, so this would be a line of credit or a HELOC that is not being used for investments. If this is a consumer balance from buying consumer items like doodads, okay, like a TV, car, boats, fancy dinners, okay. If this HELOC or this line of credit is paying for a lifestyle, then pay off that HELOC. You do not need to be carrying that balance. Okay. So now just understand that if you are using your line of credit or your HELOC for an investment, like buying real estate or stocks or a business, then don't pay it off. There's a different strategy altogether for that. Okay. The other thing is that if you've got student loans and that student loan is not a tax deductible expense, or if the interest rate is super, super high on that, then you want to look at paying off your student loan as well. Okay. So sort of any debts that you're carrying that is not an asset or not generating passive income for you or generating some sort of income for you, then you need to look at really paying those off. Okay. So that would be the first thing. The second thing would be to potentially, okay, now I'm saying it in the second place, but it's not my second thing that I would do, is look at topping up your RRSP or your TFSA or your GICs, okay? So if you have not used your RRSP, first-time home buyers limit, then topping up your RSP may make really good sense, because when you're ready to buy your first home, okay, and it has to be your first, you can then use your RSP, tap into that for your down payment. Okay, so there's another avenue for there. If you have good skill sets in buying, let's say, stocks, then putting it into your TFSA account and using that to buy stocks, because the returns are going to be completely tax-free, that may be a very good use of your inheritance money. Okay, now I say that that's potentially the second advice to use with your inheritance money, but it's not one that I would do. Okay, what I would actually do, okay, hold on. So let me take a step back. I just looked at my notes here. What I would actually use in the second position is actually make sure you have an emergency fund, a rainy day fund. Now, if you have access to a HELOC or a line of credit and your risk tolerance is pretty high, you've got like a secure job, or you've got income coming in, like passive income coming in, then maybe having that emergency fund isn't necessary. But if you do not have passive income, if you do not have a stable job, then highly suggest that the second thing you do is to get an emergency fund set up. Make sure you have anywhere from 3 to 6 months of your living expenses available, just sitting in account, ideally in a GIC. Okay, so to calculate your emergency fund, what you want to do is just figure out, okay, well, how much do I need to live off every single month? That would include your rent or your mortgage payments, food, car insurance, gas, any dinners out, any toys, doodads for the kids, any taxes, property taxes, insurance, all of that stuff that you have to pay every single month, any of your subscriptions, okay? Add all that up, and that is your monthly expenses, and you need to have at least 3 to 6 months. 6 months ideal, 12 months even better if you can do that, okay? So the reason why I say that if your risk tolerance is a little bit higher, if you've got access to a HELOC, okay, well then don't set up an emergency fund if your HELOC has enough of that room, 6 months to a year. Okay, now if you need to actually, like if you don't have a HELOC or a line of credit and you need to set up this emergency fund, okay, take your inheritance money, make sure you have that emergency fund. Now take that fund and put it into a GIC, okay? Put it into like a 3-month or a 6-month emergency fund GIC. The reason for that is that if you don't use that emergency fund and it just sits in there for 3 to 6 months, well, then you're going to make, 4 or 5%, whatever the GIC return is. If you need it, well, you just cash it out and there's no harm done there and you get access to that money right away. Okay. If you find that after 3 to 6 months, if you're able to leave your funds there and not touch it, then increase your GIC term to 1 year. Okay. That way you're making a little bit more interest all the time. Okay. So the second thing is definitely doing the emergency fund and making sure you have that. Okay. So then the third thing, which I would not do either way, is the RSP TFSA. Okay. So now the last thing that I would do, the last advice that I would give on what to do with inheritance money, okay, is actually twofold. Okay. One is to look at, is there a course? Is there a certification? Is there something that you could take as a self-improvement course to get a better job, to elevate whatever type of work you're doing right now to the next level? Okay, so let's just say, like, I've got my engineering degree, I've got my project management certification. So if I didn't have my project certification, let's just say I could take the PMP course and get designated on that. And then as an engineer, if I was still working in the engineering field, I could then now go to my current company and say, hey, I've got my PMP. I want, a higher pay. I want, to be put on this specific project that requires me to have a PMP so that I can get the experience and get a higher salary at some point. Okay. So if your inheritance money can get you to level up your knowledge, your skill sets, that will go way further than putting it into a GIC or RSPs or TFSA. Okay. That self-improvement, that knowledge that you have, it's exponential. Like you cannot put a dollar value on it, especially if it's going to help you reach a breakthrough goal, if it's going to get you to the next level. Okay. Now, tied to that is starting your own business in some way. So whether it's to buy somebody's business or to start it on your own, if you've got the drive, the motivation, the why to start a business, that would be a good suggestion on where to put your inheritance money. Because once you start that business, one, there's a lot of tax deductible expenses that come with having your own business, but then it also comes with the potential to grow it and have 2x, 4x, 10x return on your inheritance money. Okay, so that is some advice on what I would do with inheritance money. The thing I would say with inheritance money, depending on how much inheritance money it is I would say definitely meet with a financial advisor, meet with other people, and ask for their advice on what to do with that inheritance money. I would not just go and splurge it. All right. If it's a lot of inheritance money, you might want to take a portion of that and go have a little bit of fun. But the majority of that should not be for fun. Like the inheritance money, leverage it. Figure out a way to make it double in a couple of years. Make it double, like the rule of 72 if you can, right? Figure out something that you could do so that inheritance money lasts forever and if possibly generations. Okay, so that is my several minutes on what to do with inheritance money. Okay, so we are just over the hour. So thank you everybody for tuning in. I love coming on and, having a safe platform for me to share my ideas. If I'm completely off on anything I've said today, please reach out to me. Let me know. Okay, I'm always learning as well. Okay, and if I can be of any help to you, please let me know. Happy to do so. Okay, thanks everybody. Have an awesome day. Bye.